Part of the video for chapter 13. So in the first part, we covered with you horizontal and vertical analysis. Now we're going to talk and focus on ratio analysis. As I mentioned in the first part of the video, all ratios could be classified as one of these four different blocks. So first we will look at the group of ratios that talk about liquidity and efficiency. Liquidity refers to the company's ability to pay its bills, short-term bills, short-term obligations. Efficiency relates to the factor of how efficient is the management of company in generating revenues and using its resources, especially assets. Then we're going to look at the group of ratios that will talk about solvency or the company's dependence on long-term borrowing, on long-term debt. The next group is profitability ratios, which just look at how profitable the business is. And the last group looks at the company's market prospects. Okay, so first of all, you have a great summary of all ratios. And by the way, this is not a full list. There are many other ratios, but this is what your textbook refers to. And we covered practically all of them in different chapters. If you remember, at the end of every chapter, we had from 1 to 4 different ratios to cover. And you can see how all ratios are grouped into 4 categories that I just described: liquidity and efficiency, solvency, profitability, and market prospects. I don't think it is necessary to memorize formulas. You can always look up the formulas. But you have to know how to apply these ratios. What do they tell you? How to interpret them, and also what do they measure. I'm going to be using Apple just as an example of the company and we will calculate every ratio for Apple using their financial statements. So the first one, it's not a ratio, it's an indicator called working capital, and it represents current assets financed from long-term capital resources that do not require near-term repayment. So if I pay for all my current liabilities are pretty much my short-term bills, my current bills, right? So I have to pay for them, and I'm paying for them using cash and collecting from receivables and selling inventories and selling my short-term securities. So I'm paying for those liabilities from my current assets. So whatever is left after I pay for my bills is called working capital. What do I have left to invest into different projects? And the higher my working capital is, my position is better. More working capital suggests a strong liquidity position and the company's ability to pay its short-term bills. Now, again, it's not a ratio, so we just simply subtract 2 amounts. So Apple, this is a sticker for Apple, AAPL. This is the symbol used for the stock. So I'm going to go to the balance sheet. So we opened it. I showed you how to find financial statements in the previous video. So right here are financial statements. So I need the balance sheet. Here we go. I'm going to use the most recent data, 2019. And guys, these are my current assets, not mine. I wish they were mine. These amounts are in millions. So actually, Apple's current assets are $162.8 billion. So I would have to add 6 zeros. Again, it's 162.8 billion. So I'm going to take current assets, and then I'm going to take current liabilities. Right away, you see that we have more current assets, so I actually will have a positive working capital. So pretty much, Apple has $105.7 billion that they have to pay within a year. These are their current bills. So I subtract the 2, and I get working capital of $57 billion. Now, the actual ratios, we will not have to worry about zeros because they will be canceled out. So one of the beauty of ratios is that we can ignore zeros, and thus we can compare a large company to a small company. And another beauty of it is that we don't have to worry about currencies. They will be canceled out. So I can look at the company that operates in yuan, or a company that operates in euros, or a company that operates in rupees, and I can compare them to each other without converting currencies. So liquidity and efficiency, you can see right here the liquidity ratios are just these two, current ratio and asset to ratio. These are liquidity ratios. And then the rest of them are efficiency ratios. So let's look at each one of them and let's calculate them for Apple. Current ratio. So very simple, it's called current ratio because we take the same two amounts we just used to calculate working capital, but instead of subtracting them, we divide them. So it shows the company's ability to pay its short-term debt. And a higher current ratio suggests a stronger liquidity position. So again, this was the total current assets, and these were the total current liabilities. I divide them, and it's 1.54. So what does that mean? It means that for every dollar of bills I have to pay, I have $1.54 in current assets. Is it good or is it bad? I'm not sure here. Usually a rule of thumb or a guideline is that this current ratio should, if it's 2 or more, then the company is in a good position. Because not every current asset is going to be converted into cash, right? We're not going to sell all our inventory. We're not going to touch prepaid expenses or supplies. They're not going to become cash. So if it's between 1 and 2, we're not sure. So we have to do the next test, and we will use next ratio called acid test ratio to see how the company is doing. And if it were below 1, that would mean we don't have enough current assets to pay for current liabilities. So that would be negative. So the next ratio looks at the same thing, but it's more strict. It's a stricter ratio. Instead of taking all current assets, we're just going to take so-called quick assets. And quick assets, I like to think of them, it's anything above inventory on the balance sheet. And usually it's these three groups. Now, not every business will have those three groups. It's cash and cash equivalents, it's the short-term investments, and it's the receivables, accounts receivables at net. Our denominator remains the same. So I'm going to go back to the balance sheet, and I'm going to, again, this is inventories. So I take all lines above the inventory. So we're going to take cash and cash equivalents plus marketable securities, which is short-term securities investments, and then accounts receivable. I'm going to add them up, and that's going to be my quick assets right here. And then I'm going to divide them by current liabilities. And now I can say that Apple is doing quite well in the liquidity section because the business has $1.17 of quick assets. And by the word quick, we mean here they will quickly become cash, right? We can sell short-term investments. Usually the business is planning to sell them within 90 days. And we're going to collect receivables. It's net receivables, right? It's receivables minus allowance for doubtful accounts. And the business will collect them, within a couple of months. So truly, for every dollar of short-term bills or current liabilities, we have $1.17 of quick assets. So anything above 1, if the business is above 1 on this ratio, it's doing well in the liquidity section. Okay, the next ratios, they cover the company's efficiency. How efficiently does the management use the company's resources to generate revenue? And here, guys, we're going to take accounts receivable turnover. We want to see how fast does the company turn them over. We want the company to collect receivables faster. Now, sometimes if the company collects receivables too fast, it might mean that customers are leaving us and going to our competitors who offer better credit terms. So usually there is some kind of range. So what do? We take net sales, which is pretty much revenue, right? Same thing, net sales or revenue. And we divide it by the average AR. And guys, whenever you see average, that's what you have to calculate first. So for average receivables, so average anything, we take the current year's amount plus the previous year's amount, and we divide it by 2. So I'm looking at the balance sheet, and guys, we have information for 2 years, right? So I'm going to add these two amounts of receivables together, 22,926 plus 23,186, and then I'm going to divide it by 2. I'm doing it right here. I will calculate this average, and then guys, we're going to take net sales. Where do we find net sales? We have to go to the income statement. Again, many companies use the name of the statement of operations. It could be called statement of earnings. It could be called P&L statement, profit and loss. It's all the income statement. Here is net sales, total net sales, 261.74. Again, this is $260 billion. But we don't have to worry about zeros. They will be canceled out. So I plug it in right here, and we get 11.3. What does it mean? It means that Apple collects on its receivables 11 times a year. I like to think of it a little differently. I take the year, 365 days, and I divide it by this ratio. So Apple collects on its receivables every 32 days. Again, that sounds pretty good. I don't know, but then you can compare this ratio, this factor, to Apple's competitors. You can compare it to the industry standards and to see how Apple is doing. The next ratio is pretty much going to give me the same result, 32 days. It's just going to be a little bit off. And what we do with the formula, we're just going to flip it over. We're just going to flip it over. And it's called days sales uncollected. Look at the formula. So now I put accounts receivable as a numerator, and we do not do average here. It's just the current year's accounts receivables. And now we divide it by net sales, and then we multiply it by 365. When I go through the calculations, I get 32 days. This is in days, right? How many days does it take us to collect on receivables? 32 days. I want you to notice that I pretty much calculated, it's just a little bit off, the same number of days in the previous ratio. So days sales are uncollected. My sales remain uncollected for 32 days, and then I will collect that. The next two ratios also relate to each other and have to do with inventory. Again, inventory ties up our cash. It diminishes our liquidity. So we want to see companies that turn over their inventory faster. Again, of course, it depends on the type of business. You cannot compare a convenience store with a jewelry store, right? But in general, we want inventory to be turned over faster. However, if the inventory if the inventory turnover ratio is very high, that might mean that the company is running out of stock and just customers cannot buy stuff that they want to buy. So this is the formula: COGS, cost of goods sold, divided by average inventory. Here's that word average again, right? So we take inventories for 2 years, add them together, divide by 2. So we go to the balance sheet to get the inventory amounts. So we add these two amounts together and divide by 2. This is what I'm doing right here. And then, guys, COGS is, we call it cost of goods sold in this class. Many companies use the phrase cost of sales. It's the same thing, cost of sales. Here it is, cost of sales. That's cost of goods sold. So 161,782, I plug it in, and I receive, my number is 40 times a year. We completely sell our inventory. Again, I'm using we. Apple sells their inventory 40 times a year. In order for it to be more understandable, again, I take 365 days divided by the inventory turnover. So Apple turns over their inventory, no surprise, right? Very fast. Every 9 days, their inventory is completely sold out. And of course, you know that about iPhones and Apple computers. It's sometimes you cannot even buy them. They go so fast. They are sold so fast. And guys, the next ratio is called days sales in inventory. And again, look at the formula. I'm just going to flip it over, right? I'm just flipping it over. I'm taking inventory for current year, not average inventory, and dividing it by cost of goods sold and multiply by 365. And again, look, it's 9 days, right? How many days does it take to sell inventory? Completely 9 days. It was 9.1 days right here and 9.3 days right here. The last efficiency ratio is called total asset turnover. Why do companies purchase assets, right? They buy assets in order to generate revenue, so sales. So as an investor, current investor, I'm very interested in this ratio because I pay my money and buy shares of stock, and then the company uses my money to acquire assets, to invest into assets, and then those assets should generate more sales. So this asset turnover ratio, I want it to be higher. So look at that average again, right? So we take net sales and we divide into average total assets, not current assets, all assets. And again, whenever you see average, we do this calculation first. So look at this denominator. I'm going to use the numbers from the balance sheet right here. So do not plug in current assets, take total assets. So these two amounts added together divided by 2. Those two amounts added together divided by 2. And then net sales we took from the income statement. And we've seen it before. So the income statement, this is our net sales for the current year. I get 0.74. The way I can think of it is every dollar of assets for Apple generated 74 cents in revenues. And again, we need to, I don't know if it's good or bad, I would need to look at the previous year's calculation for the total asset turnover, or we can compare to the industry average, but that's what it means. The higher, the better. So the next group of ratios looks at solvency, right? We're going to look at debt in some way, at total liabilities. And guys, it's very nice because these three ratios actually, the debt ratio, the equity ratio, and debt to equity ratio, they're all looking at the same stuff, just from different perspectives. So I actually summarized all of them right here on this slide. So total liabilities, total equity, right? I'm going to the balance sheet right here for Apple. I'm going to look at total liabilities. Again, don't confuse with current liabilities. Total liabilities, 248,028, 248,028. Total equity, 90B right here. Total equity, 9488. And then total liabilities and shareholders' equity, I want to remind you, it's the same as total assets, right? Assets are equal to, that's our balance sheet, equal to liabilities plus equity. Is 338,516 right here. And guys, these are three ratios. So what is debt ratio? Debt ratio is total debt divided by total assets. The debt ratio expresses total liabilities as a percent of total assets, right? I have total assets right here. So we just took 248,028, all liabilities divided into all assets. So what is the percent? It's quite high. It doesn't look that good, right? The company relies heavily on debt. For every dollar of assets, 73 cents are financed with borrowing. And then it leaves me with the question, well, how much is financed with equity? I can take equity and divide it by total assets, or I can just look at my debt ratio and subtract it from 100%, right? So if my debt ratio is 73.3%, then 100% minus 73.3 gives me 26.7. And only 26.7 cents of every dollar of assets is financed with equity. So this ratio is quite negative. Apple relies much more heavily on debt. And then the third ratio is called debt to equity ratio, It measures what portion of company's assets are contributed by creditors, right? So what we do to debt to equity ratio, just follow the name. We take total debt, 248,028 right here, and we divide it by equity, stockholders' equity, which is 9488. So what it tells me right here, it's a little bit hard to interpret. For every dollar of equity, how much do we have in liabilities? Apple has $2.70 in liabilities for every dollar of equity, which means Apple has almost 3 times as much debt as they have in equity. So this is one of those ratios. This is the ratio I want it to be lower. If this ratio is 1, it means 50% of my assets are financed with debt and 50% are financed with equity. If it's below 1, it means we have more equity than liabilities. If it's above 1, and here we're way above 1, that's not good. The next one, we cannot really calculate it because we don't have enough information. It's called times interest earned. I'm not going to ask you many questions on this on the quiz or the exam. This is the formula. This is how to calculate it, and it's the most common measure of the company's ability, of the company's operations to provide protection to long-term creditors. So if we are current creditors, we want to see that the company will still be able to pay us interest that they owe us. Okay, the next group are profitability ratios. Guys, pretty much most of them, except for gross profit. Instead of saying, well, Apple made how much in net income, and I go right here, well, they made in net income $55.3 billion. Sounds good, right? But, it's just the amount. I will not be able to compare Apple to a small business. It's a large amount. By the way, if I look to the previous year, it actually went down. So we want to divide this number. We want to take net income and spread it over some kind of other account. And so here we will have profitability, we will have net profit margin, we will have return on assets, we will have return on equity, we will have earnings per share, and we will have gross profit margin. So in every single ratio except for the gross profit margin, we're going to take net income in the numerator and we're going to divide it over some other amount. So the net profit margin is net income divided by net sales. So we take the bottom of the income statement and we divide it into top, total net sales. This is a very easy ratio to understand. It just shows right here that for every dollar of sales, Apple earns 21 cents in net income. So when you go and you spend $1,000 on the Apple computer, they will keep $210 out of this 1,000 as their profit, net profit, right? And again, it's actually quite a good ratio for Apple, but we can compare it to other businesses, to previous years, to industry averages, to see if Apple is doing well or not. Now, the next one is gross profit margin. So in the numerator, instead of net income, we take gross profit, right? And I want to remind you that gross profit, sometimes it's called gross margin. I think actually Apple calls it gross margin, same thing, is sales minus COGS, right? So when we go to the income statement, it's right here, right? We take total sales minus total cost of sales. How much money is left to cover expenses and then keep profit? So gross margin is $98.4 billion. I take gross profit right here, divide by net sales, and I have 38 cents. So from $1 of sales, we have 38 cents left, right? To cover expenses, and then keep net income. So how much do we spend on the cost of sales, cost of goods sold? Well, we're spending 62 cents. So from every dollar, so again, when you buy an iPhone for $1,000, right away, Apple has to pay for cost of goods sold, for what they manufacture, what they produce. They have to pay $620 out of it. And they have only $380 left now to pay for operating expenses, to pay for rent, to pay for insurance, to pay for salaries in the headquarters, non-manufacturing salaries. And then they will pay for those and they will keep net profit or net income. So I put together here a pie chart. This is what managers love to see. So sales is $1, 100%. So 62 cents go to cost of goods sold. So we're left with 38 cents. This is our gross profit margin. Out of that 38 cents, 21 is left in net income. So if I take 38 minus 21, I can see 17 cents go to the operating expenses. Very visual. Okay, the next one is called return on total assets. And guys, this is what's known as ROI. I'm sure most of you have heard about this term, return on investment, because my assets are my investments that are supposed to generate revenues for us. So we take net income and we divide it by average total assets. So again, net income divided by average, right? 2 years added divided by 2, 16.16 or 16%. Again, every dollar of asset generated 16 cents in net income for Apple, 16%. That's actually, I mean, imagine if you invest your money, if you put your money in the savings account, you're probably going to get just 0.1%, right? And the stock market, what does it return now? What about bonds? If you put it in the CD, it's probably going to be just, right now 1.5%. The stock market is doing crazy, goes up and down all the time, so it depends. But in general, this is a good return. It means if you invested $1,000, right, in Apple, you would get $160 as your interest back. Okay, return on equity. Again, we take net income, we subtract preferred dividends, and then we divide by average equity. I'm not going to calculate this one. But again, it will tell you how much profit is made for $1 of equity, how much profit is made for $1 of assets, how much profit is made for $1 of sales. And then the last one, we actually just covered it in Chapter 11. It's the single most widely used ratio. It's actually the ratio that companies report right here. It's the only ratio that is actually calculated and reported on financial statements. So we take, I mean, the formula is a little bit more complicated, but in general, we just take how much does every share of common stock generate, how much profit, net income does it generate. So we take net income, we do have to subtract preferred dividends, and we divide it by weighted average common shares outstanding. We cannot calculate it ourselves, right? And the higher measure means better profitability. So, so I'm just going to look it up. That's what I did. I'm going to look up in a stock quote, and I usually go to Yahoo Finance, and I'm going to look up Apple's quote right here. So it's AAPL. Here we go. So this is shares of stock. Apple lost $4.73. But right here you can see EPS, earnings per share. So it's $12.73. So Apple made $12.73. And then you can look up other businesses and see how they're doing. The higher ratio means the company is performing better, has better profitability. And the last two ratios have to do with market prospects. We're not going to calculate them. We're just going to also look them up. And so the first one is PE ratio, price earnings ratio. We're going to take market price per share. So like how much is one share of Apple is traded at. And then we're going to divide it by EPS. And how much actually profit did the company make, right? So a high PE ratio means that the company is overvalued. Sometimes you have these businesses that are very popular because of social media, because, they're just hot for some reason. And so their share price is very high. But actually the amount of profit every share makes is very little. So everything being equal, if P ratio is high, and by high I mean a few hundred, it's going to be 300, sometimes 500, 600, it means that the market price is 600 times higher than the amount of net income made per share. So if P ratio is very high, that means that there is a possibility of the company's stock going down in the future. It means that the stock is overvalued. If it's not high, and I would say, if it's about 20, 25 or lower, that means that the stock is undervalued, and everything being equal, there is a chance that the stock will grow in price. But there are other things that happen, right? So we don't always follow the rules. So right here is PE ratio 22.71. So that doesn't look like a very high PE ratio, right? 22.71. It doesn't look like that Apple stock is overvalued right now. So it looks like still a good buy. And then the last one is dividend yield. We're going to take cash dividends per share and divide by the market price. And again, it's reported right here. This is the actual amount. So $3.08 of dividend. And the yield is 1.05%, which means that that's the percentage of the market price you're going to be paid in dividend. And the higher percentages means that the company is paying a higher portion in dividend. If you can find anything above 2.5%, 3%, that's very high. Now, there are a lot of companies, as we discussed in Chapter 11, such as Netflix and Alphabet for Google, that do not pay any dividend. So if you look up those companies, say for example, I go to Google the name of the company is Alphabet, you will just see NA right here, NA, which means they do not pay any dividend at all. So this concludes our last lecture and last slide for the financial accounting course. I hope that you will take my managerial accounting course next, and I wish you good luck in all of your in everything you're gonna do. Thank you so much.